After last month's FOMC meeting, Chair Powell stressed the Fed will take a data-dependent approach when considering future hikes. The data has been less than ideal in two key areas of the market as of late. First, housing market tighter than ever, home construction falling 11.3% in August to the lowest level since 2020, highlighting the declining housing affordability. And oil prices have rallied in recent days, with robust energy prices driving up inflation during August. So what's the Fed's biggest hurdle, housing or oil? Joining us now to help put some clarity around that question, we've got Kyle Campbell, American banker, staff writer. So Kyle, when we think about what's going to maintain the majority of the conversation as it pertains to their two-day meeting for the FOMC, what's it going to be? Is it going to be housing or oil?
That's a great question, and certainly both are drawing up a lot of attention right now. But I'm going to say housing is going to be the bigger concern because oil prices are, they're volatile. It's a commodity that's set globally, and I think you're probably going to hear Chair Powell say something to that effect tomorrow during tomorrow's press conference. So I think they're going to kind of look past that and look at the housing side of things, because that's something that is, that's sticky. That's going to be there for a while, and it's complicated because you've got, still strong underlying demand for housing, of course, because it's an essential need. But this limited supply, and it's going to be a problem for a while, and one that I think the Fed is, just going to have to sort of, grit its teeth and push forward through, because they don't really have a lot of levers to hit the actual the real issue, which is supply.
So, Kyle, what do you think that then tells us about the Fed's future policy when you look ahead to the end of the year and into 2024? Lots of speculation about the fact that we're going to be in this higher for longer environment now, maybe for even longer than initially forecasters have been anticipating. Deutsche Bank coming out with a note this morning saying just that. What are you expecting to see from the Fed, not necessarily from this meeting, but when you look out into next year?
Yeah, I think they're going to be, they intend to hold policy, their monetary policy, high for a while. But I don't know that they're necessarily going to be able to do that, because I think that there's always some sort of hiccup along the way that is going to, trigger some kind of a response. But what is going to be interesting is what happens once they do start to bring down start to bring that interest rate down, especially on the housing side of things, because you have this really big pent up demand for housing. You have all these folks who, are locked into a pretty low rate right now, who are holding on to their home maybe longer than they want to. Maybe they want to sort of move and retire. Maybe they want to just sort of upgrade, but they can't because they don't want to take on that higher interest rate payment. Once you start to see rates come down even a little bit, I think you're going to see a surge in interest from buyers, and then that's going to sort of drive prices up even more. So how they sort of manage that part of the equation is going to be interesting. But I think it also speaks to sort of even further into the future, how the Fed is going to navigate sort of critical moments in the economy, and are they actually ever going to lower their interest rate as low as they did in 2020 and sort of post GFC, where you go to sort of that lower bound. And you create these sort of issues where it just, it becomes, you have this sort of stagnation in the housing market, and you create these affordability issues. So that's what I'm going to be interested in, sort of very long term.